Before we get into the details of today's video, join our $100 giveaway! Just comment blockchain of Ra below. The winner will be announced in our Telegram group. Don't miss your chance! Elon Musk just reignited chaos with a brutal attack on Trump's proposed $2.4 trillion economic plan, calling it a disaster in the making. Trump hit back with threats to strip Tesla and SpaceX of federal contracts. Within 24 hours, $150 billion was wiped from Tesla's valuation, dragging down the entire stock market and crypto with it. XRP and XLM holders felt the shock directly as both tokens dropped 7 to 8% in hours. But this isn't just about price dips. It's about power, influence, and what happens next. Here's the full breakdown you can't afford to miss. The Musk-Trump feud that triggered it all. On June 5th, the financial world was blindsided when Elon Musk took to X and dropped a bombshell critique of Donald Trump's proposed $2.4 trillion economic stimulus plan. Musk didn't hold back. He called it a pathway to hyperinflation, warning that printing trillions more in stimulus could implode the US dollar and destabilize capital markets globally. His post went viral within minutes, sparking both applause from fiscal conservatives and rage from Trump loyalists. Within hours, Trump responded with fury during a rally in Florida. He called Musk a globalist tech overlord and threatened to revoke all federal contracts from both Tesla and SpaceX if Musk continued to publicly undermine the proposed stimulus. Trump added, "If Elon wants to play politics, he can do it without taxpayer dollars." That statement lit a fire across financial media. CNBC, Bloomberg, and Reuters ran with the story, amplifying the feud in real time. By the afternoon, the ripple effect had begun. Tesla's stock plunged 14% in a single trading session, evaporating nearly $150 billion in market capitalization, its steepest one-day loss since early 2022. But this wasn't just about Tesla. Markets everywhere shuddered. Nasdaq futures turned red, Dow Jones sank over 600 points, and the S&P 500 entered a sharp decline. Global equity markets followed suit, with Tokyo, Frankfurt, and London all closing lower in direct response to the Musk-Trump headlines. Analysts on Bloomberg labeled it a political contagion event. Investors were already on edge. The Fed had signaled no rate cuts until at least Q4, inflation remained sticky, and fresh tariffs on Chinese electric vehicles were expected by month's end. The Musk-Trump feud was the spark that ignited the dry powder. To make matters worse, tech ETFs, many heavily weighted with Tesla shares, started triggering algorithmic selling. ARK Invest's flagship innovation fund dropped over 8% that day, and retail investors flooded Reddit and X, wondering if this was the beginning of another dot-com-style unwind. But it wasn't just about equities. The VIX, the market fear index, spiked to its highest level in 4 months. Gold prices surged past $2,400 an ounce as capital sought safety. Treasury yields tumbled as investors rushed to bonds. And hovering in the shadows of all this was crypto. XRP and XLM holders saw what was coming. When power players like Musk and Trump collide, it sends a shockwave through every asset class. And that's exactly what happened next. How crypto got dragged into the crossfire. While traditional markets were getting slammed by the Musk-Trump fallout, the crypto markets weren't spared. In fact, they were hit even harder. Just hours before the chaos, Bitcoin had broken above $108,000, sparking celebration across crypto Twitter. It looked like a potential breakout, but what followed was a violent reversal that caught most traders off guard. The Musk-Trump headlines hit during peak U.S. trading hours, right as institutional trading desks were reallocating portfolios. Within minutes, panic spread across digital asset markets. Over $830 million in leveraged crypto positions were liquidated in under 12 hours, according to CoinGlass. Margin calls cascaded across Binance, Bybit, and OKX as over-leveraged bulls were flushed out. Bitcoin plummeted from $108,000 to under $101,000 in a single candle. That's a $7,000 crash, wiping out billions in market cap almost instantly. Ethereum didn't escape the carnage either. It fell below $5,000 for the first time in weeks, erasing nearly 10% in value. But the most concerning moves were in utility-driven tokens like XRP and XLM, which are typically less correlated to hype cycles and more tied to global macro and institutional activity. XRP plunged over 7%, briefly touching $2.01 and putting its critical $2 psychological support level in jeopardy. That $2 line has historically acted as a bounce zone, especially during volatile news cycles. If it breaks, analysts warn a retrace to $1.72 could happen fast. XLM, often viewed as XRP's compliance-first cousin, followed closely behind. It dropped nearly 6% within 24 hours, with some exchanges posting lows around 21 cents. Though XLM doesn't usually follow BTC tick for tick, the risk-off sentiment in global markets was too strong to resist. Across on-chain analytics, you could literally see the shift. Glassnode reported a spike in exchange inflows for both XRP and XLM, suggesting short-term traders were rushing to exit positions. Yet, wallets holding XRP for more than 90 days barely moved. The long-term holders, they sat tight. The weak hands were flushed. The diamond hands stayed firm. The broader narrative was clear. This wasn't just about crypto performance, it was about sentiment. When headlines suggest Tesla might lose federal backing and SpaceX could be banned from defense contracts, institutional investors reprice everything. Risk-on assets are the first to go, and that includes altcoins, even those with real-world use cases. But here's what's key. Neither XRP nor XLM saw any decline in network activity. In fact, XRP Ledger processed over 1.2 million transactions that same day. And on the Stellar side, USDC movement across anchor partners remained stable. So while price dipped, utility didn't. That's the detail most people missed. The short-term dump was emotional. The fundamentals? Unchanged. And that's what sets the stage for what happens next. XRP and XLM's fundamentals still stand strong, even as market chaos unfolded and speculators rushed for the exits. One thing became crystal clear. XRP and XLM didn't flinch where it matters most. Fundamentals. This wasn't some meme coin liquidity flush. This was macro-driven volatility smashing into digital assets. And yet, when you strip away the fear, the tech behind XRP and XLM has never looked more resilient. Let's start with XRP. Its core use case, cross-border institutional settlement, remains not just intact, but growing. RippleNet's on-demand liquidity, ODL corridors are expanding aggressively, particularly across Asia-Pacific and the Middle East. New partnerships in Singapore, the UAE, and even Kazakhstan are strengthening Ripple's liquidity network. Just last week, Ripple inked a deal with a major regional bank in Abu Dhabi to streamline real-time remittances into India and Southeast Asia. That's real enterprise usage with real transaction volume. The underlying architecture powering XRP, the XRP Ledger, XRPL, hasn't blinked. Uptime remains flawless. Transaction throughput continues to average over 1 million per day. And dev activity around the upcoming AMM and hooks features has increased, meaning the future of programmable liquidity on XRP is right around the corner. This isn't the behavior of a collapsing asset. It's the foundation of a serious financial network. Now turn to XLM. While it took a short-term price hit, the activity under the hood is accelerating. Soroban, the smart contract layer built specifically for compliance-first DeFi, just onboarded a new DeFi protocol, Palago Labs. This platform is building a decentralized trade finance layer on Stellar, designed for exporters in Latin America and SMEs in Africa. It's one of the first real-world DeFi plays actually working with local regulatory frameworks, not dodging them. And the Soroban testnet? It's humming. Developer activity has doubled over the past 90 days. Tools, SDKs, and documentation are maturing. We're not talking vaporware. We're talking real smart contract architecture, optimized for business and compliance, not just yield farming. Meanwhile, network fundamentals speak volumes. According to Messari and Stellar expert, long-term XLM holders, those with tokens sitting untouched for 180-plus days, have held firm. Exchange flows for XLM remained minimal during the crash, while developer wallet activity actually increased. It's the opposite of a dying chain. And here's the kicker. Institutions using Stellar rails haven't stopped. In fact, new money is flowing through it. USDC on Stellar has remained one of the most efficient stablecoin corridors for money movement, especially in Africa and Southeast Asia. Tokenized treasury pilots from fintechs in Argentina and Kenya are actively using Stellar's blockchain to issue and settle assets. These aren't just testnets. These are live pilots. So while headlines screamed, "Crypto crash," and speculators dumped tokens in a panic, the builders, and more importantly, the institutions, didn't flinch. XRP and XLM are proving once again that they're not hype coins. They're financial infrastructure. And when the smoke clears, that's the kind of asset class that institutions reprice quickly. Ignore the noise. Watch the rails. The money never stopped moving. And for XRP and XLM, that's everything. The macro view, what's really driving the panic. Let's step back. The Musk-Trump feud may have triggered the headlines, but this correction wasn't just about two billionaires trading shots on X. This was about the deeper structural fractures surfacing all at once. Macro pressure points that have been building for months finally breaking the surface. Trump's proposed $2.4 trillion stimulus plan sent shockwaves not because it was unexpected, but because of how aggressive it was. Massive tax cuts, new infrastructure spending, and a military expansion, all with no clear funding mechanism. That spells one thing: fiscal overdrive. And smart investors know what follows: currency debasement, inflation risks, and eventually Federal Reserve intervention. Musk was right to call it a pathway to hyperinflation. The bond market certainly reacted like it was. Yields on the 10-year Treasury spiked above 4.7%, but the real signal came from the dollar index. It wobbled. A weaker dollar isn't just about FX markets. It ripples into everything from commodities to crypto. A falling dollar often boosts crypto demand, but in this case, the market saw it as instability, not opportunity. And then came the ECB. The European Central Bank cut rates for the first time in nearly 5 years, signaling that monetary easing is back on the global agenda. This wasn't just a European move. It was a signal, one that the global economy might be softening, and central banks are getting nervous. Rate cuts mean liquidity. Liquidity means risk on eventually. But in the short term, it means confusion, uncertainty, volatility. Pile on last Friday's disappointing U.S. job growth data, just 142,000 new jobs versus expectations of 190,000. And the message is clear. The economy isn't as strong as it looks. The labor market is cooling. Consumer spending is slowing. And Wall Street is starting to price in not just one Fed rate cut, but possibly two before year-end. And as if that wasn't enough, new tariff rumors dropped. The Biden administration floated the idea of imposing 100% tariffs on Chinese electric vehicles. Markets hate tariffs. They're anti-growth, they raise costs, and they escalate geopolitical tension. With China already pushing back, investors are now bracing for a renewed trade war narrative, something that hasn't been in the headlines since 2019. So what happens when you combine all of this? A fiscal expansion from Trump, a weak jobs report, an ECB rate cut, a wobbling dollar, and tariff fears. You get panic. You get capital rotation. You get a sell first, ask questions later environment. Risk assets get hit. Even crypto. But here's the twist: the smartest money isn't running from crypto. It's repositioning within crypto. According to Glassnode and Sentiment, there's been a clear uptick in stablecoin inflows and wallet accumulation for high-utility assets. XRP and XLM wallets with balances over $100,000 have grown 2.3% and 2.7%, respectively, in the past 48 hours. That's not retail FOMO. That's smart money hedging against long-term inflation and fiat instability. Why? Because when traditional systems shake, the spotlight turns to assets designed to replace them. XRP is literally built to replace SWIFT. XLM is optimized for tokenizing assets and settling digital currencies across borders. These aren't hype coins. They're alternatives to the current system. The macro view isn't bearish on crypto. It's bearish on fiat credibility. And that's exactly why XRP and XLM matter more than ever. What XRP and XLM holders need to know now. This moment feels chaotic because it is, but volatility doesn't just shake out weak hands. it also opens rare windows of opportunity. For XRP and XLM holders, this isn't the time to panic. It's the time to refocus. Short-term price action may continue to swing wildly, especially if more political headlines hit or macro data worsens. But here's the key. Both XRP and XLM are positioned beyond the noise. They aren't built on hype cycles. They're built to solve structural problems that traditional finance still hasn't cracked. Let's start with XRP. Despite dipping dangerously close to the $2 support level, the network remains fundamentally strong. Ripple continues expanding on-demand liquidity corridors, particularly in Asia-Pacific and the Middle East, two regions aggressively digitizing finance. In fact, just this week, Ripple confirmed a new partnership with a major UAE banking group, expanding real-time remittance corridors into India and Southeast Asia. That's not speculation. That's utility in motion. The $2 price zone is more than just a line on a chart. It's a psychological level backed by liquidity clusters and past breakout history. If it holds, and early indicators suggest it will, it could serve as a launchpad for XRP's next leg up, especially if market volatility cools in the coming weeks. Now let's talk about XLM. Stellar has quietly been executing a different playbook, focusing on real-world adoption, DeFi integration, and cross-border fintech rails. Just days ago, Palau confirmed it will expand its USDC stablecoin pilot on Stellar's rails, citing Soroban's performance and compliance layers as key differentiators. Behind the scenes, institutional wallet onboarding is increasing. New anchors are integrating with Stellar's APIs, giving financial institutions seamless ways to interact with fiat and digital assets. These are not loud partnerships. They're targeted, surgical. They don't make headlines, but they're building an ecosystem designed to last. Data supports this. Whale alerts show that XLM wallets holding over 1 million tokens have grown by over 3.1% since the start of June. That's not retail panic. That's strategic accumulation. What should holders take from all this? 3 things. Zoom out. Daily candles and viral headlines don't tell the full story. Infrastructure matters. Partnerships matter. Utility matters. And both XRP and XLM are delivering where it counts. Watch the key levels. XRP's $2 support is your line in the sand. If it breaks, a retest of $1.70 is possible. But if it holds, we could see a bounce toward $2.50 plus as confidence returns. XLM's immediate zone of interest is the 18 cents range. A push above 22 cents would signal renewed institutional interest. Understand the game. Political drama, macro shocks, and billionaire feuds will continue. But in the end, systems that solve real problems like cross-border settlements, compliance-first smart contracts, and on-chain fiat interoperability win. XRP and XLM are playing the long game. So while others are panic selling into red candles and clickbait, smart holders are doing what institutions do. Accumulating when fear is high, positioning before clarity returns. This isn't just a correction. It's a stress test. And the assets passing it, XRP and XLM, are showing you what resilience looks like. This isn't just another celebrity feud. It's a signal. When power players clash, markets tremble. But if you're holding XRP or XLM, you're already ahead, because these aren't hype coins, they're built for real-world finance. Make sure you're subscribed so you don't miss what comes next, because the next move could change everything.